The S&P 500 falling back below a key technical level this Thursday afternoon. Also, the Dow Transports falling into correction territory. Let's see what all this means for the market's direction. Great, we're having that Kevin Kelly with us, perfect person for this. He is the CEO or the managing partner of Benchmark Investments. Kevin, so are we in for another leg down? We were just coming back up after that big drop last week.
Yeah, the market's really trying to digest what the higher interest rate environment really means for companies next year, because earnings are doing very well. But when you look at a company, their earnings are predicated on their operating margins, right? How much they can actually make from their sales. And the problem that they're having is a dual threat of the higher cost of labor as well as the higher cost of capital. So what will that mean for the first quarter, the second quarter of next year? So the guidance is really muting some of the great returns they've had this year on executing their business plans. So I don't think we'll have another leg down. I think we're going to try to digest what the managements are going to guide us.
Not another leg down, even though today we technically we got the S&P 500 back below its 200-day moving average, the Dow Transports and the Russell 2000 in correction territory.
Yeah, so I think one of the reasons why I don't think there's going to be another leg down is that you're seeing really a topping effect happening in the 10-year Treasury. So we're seeing actually yields are coming down. So that's going to lend a bit of a reprieve to the markets. Another bit of a reprieve to the markets will be the stock buybacks. They've been blacked out from buying their own stocks. So you're going to have a natural seller come into the market over the next month, and we've seen companies do opportunistic buybacks this year. So I think that's going to be what's going to happen over the next 30 days, which lends an underlying bid to the markets.
So Kevin, perhaps we won't need to see what some people say you need, the washout, the capitulation. We got the NASDAQ down 9.9% last time, just shy of correction territory, but we don't need that whole washout.
No, and I think that's an important point, because you're seeing that we're actually getting close to, bear market territories, but we never fully enter them. And one of the reasons why is look at the strengthening economy, right? We are still getting above a 3% GDP print. We are still getting inflation. We have a healthy and robust economy. Now, there may be some tremors in the global market, but we've seen the market digest trade concerns. We've seen the market digest geopolitical concerns, and the economy is doing well. So a bear market is far from the horizon over the next couple of quarters. It would have to be an 18-month out story.
You're saying digesting geopolitical concerns today. Market's somewhat rattled by Steven Mnuchin, the Treasury Secretary's withdrawal from that Saudi conference.
Yeah, and I think and that's not a geopolitical concern, right? That's actually an equity investment concern, right? That's not going to impact the markets, okay? If Steven Mnuchin isn't going to go over to Saudi Arabia, that's not going to reverberate through the United States economy. What that's going to do is certainly impact a lot of private equity investments. We've seen SoftBank sell off 8% off of that. So I think it has to do with a funding and equity concern. I don't think it has an economic concern.
And lastly, S&P Home Builders ETF right now down 2.7%.
Yeah.
I mean, Home Builders had a tough week, down to 10% this month. Stocks falling, Lennar down, KB Homes down. What do you make of Home Builders right now?
Well, home builders have certainly had not only a tough week, but also a tough year. And that also goes back to there's a lack of housing, but also if you look at the consumer side of the ledger, the consumer is certainly getting higher interest rates. And home affordability is actually at its lowest it's been in over a decade. So as you start to see people looking at different housing concerns, they're looking at also renting. So you're starting to see that so the affordability is actually on the renting side as opposed to the owning side, because when you buy a home, it's actually not an investment, right? You're actually buying it for personal uses. You're not generating any rental income off of that. So that's actually what's impacting housing concerns right now. And so Lennar is trading actually at liquidation value, and they expect to sell 50,000 homes next year. But what are the 50,000 homes going to be sold the year after that? So the market is actually discounting the cash flows for a few years out, not next year.
So at this point on home builder stocks, how would you play it?
I would actually stay neutral, because we actually don't know what the ramifications are for the mortgage market, given that we do know that the Federal Reserve is most likely going to raise rates in December. So that is putting a pause on home selling, as well as consumers going out and getting new mortgages.
All right, Kevin, thanks a lot.
Thanks for having me.
Appreciate it. Our thanks to Kevin Kelly of Benchmark Investments. I'm Fred Katayama. This is Reuters.